And we have finally arrived to the week of weeks in markets. This is Ilya Spivak, head of global macro here at tastylive, and this is Macro Money. And it's Fed rate cut week. After months and months of speculation, this is when it actually goes down. Not surprisingly, that is the focal point for the macro narrative this week, but it's not the only thing that is on the menu for markets. That, of course, will be what we occupy ourselves with today, along with a sense of what all of these things might mean for the full range of financial assets, be it stocks, currencies, or bonds and commodities, because what we face here is an inflection point. And it'll be very interesting to see how the markets move to resolve it. First, we'll begin with a sense of what the markets did last week and why they did it. And then jump straight into the many, many high-profile macro waypoints on the calendar this week, with, of course, a focus on the U.S. Central Bank. So let's first consider we had a fairly straightforward week last week looking at the end results. S&P and NASDAQ up with significant gains, almost 4% for the S&P, almost 6% for NASDAQ. Yields down across the curve for a second consecutive week, the 10-year down, the 2-year down. We have gold with strong gains up 3.4%, and the dollar soggy against its major counterparts, down a little bit against the euro, down a bit more against the yen, which of course rhymes well with lower yields. The yen tends to do particularly well when yields are falling because, of course, like gold, it yields next to nothing. So we get a sort of improvement in its appeal when yields come down. And the story seems to paint itself here. Crude oil, not surprisingly, marching to the beat of its own drum, as it has been for quite a few weeks now. But outside of that, the major assets are lined up to tell a dovish story ahead of this Fed policy announcement, which, of course, is interesting because much of what we see here as end of week results is the result of price action that happened largely through the second half of last week. We really don't have a story here in the front part of the week, not surprisingly, because U.S. CPI data came out last week, and there was much speculation about what that could mean or not mean for setting the stage ahead of this week's Fed announcement. Ultimately, that data came out almost exactly on the screws, almost perfectly in line with expectations, just a slight bit of warmth in core CPI relative to forecasts, but nothing much. Ultimately, the markets shift to 87% chance of a 25 basis point cut this week from the Fed, and only 13% chance of a 50 basis point cut in the moment. And that seemingly marks the reversal. And of course, what follows is the dovish adjustment we now see in front of us reflected in the price action. And when we look at those Fed policy odds, what a difference there is in what the current setting is versus where the markets were in the wake of that CPI report. What we have here now, 65% chance that the Fed will cut by 50 basis points. That's this right here. Lining up with a 35% chance that we are going to get a 25 basis point cut. Needless to say, that means we are certainly getting some kind of a cut as far as the markets are concerned, but with virtually nothing extra after CPI, which gave a different lead altogether, the markets are overwhelmingly set up for a 50 basis point rate cut. Even just Friday, it was more 50-50. And even just a week ago, we were looking at barely over 20% chance that we're going to get the larger cut and overwhelmingly favoring the smaller version. A week ago, looking at a 70-30 spread in favor of the 25 basis points versus the 50. So the markets have gone through quite the transformation in a relatively short period of time as we prepare for this Fed policy announcement. We are going to get a little bit of economic data ahead of it. By way of the retail sales report, the August number is expected to give us a 0.2% gain. That's obviously a step lower from the prior month's 1% increase. And needless to say, the main question here is whether this data means anything and whether it actually has market moving potential from a practical perspective while everybody is waiting for the Fed. Indeed, this would be a tertiary indicator, or at best, let's say a secondary one, before we essentially hear from the horse's mouth. And so it seems like this is probably not the kind of thing that's likely to have lasting influence on markets near term. It is worthwhile to mention that U.S. economic data has stabilized a bit relative to forecasts, but it is still tending to underperform. We can see on this economic surprise index, we're sub the 0 level, which means the surprise risk probabilities tend toward disappointment, even though the quotient by which they are disappointing seems to have anchored a bit. So maybe we're looking at some kind of normalization in U.S. economic data flow to come, but for now, we're looking at data that still tends to miss more so than not. So maybe there's a bit of a softer response here on the retail sales reading. It's already expected to be a meaningful swing lower, so maybe you miss a little bit relative to that, but how much further dovish repositioning something like that inspires when you have already such heady expectations before the Fed finally meets? You probably don't have a whole lot of market moving potential there near term. What is that dovish setting? Well, here's where we stand now. In the gray is the outlook for this year. In the yellow is for 2025. That's backed out from Fed funds interest rate futures. The dark line there is the S&P 500, just to give us a sense of where we are on overall risk sentiment. In the orange is the sum of this year and next, to give us a sense of the overall cycle bias. And what we see here is this sort of perpetual evolution of how policy expectations line up with sentiment. We can see, for example, here from July into August, stock markets did not like this more dovish perspective on policy after the Fed finally signaled it's ready to make its move starting from early July. They bounced even as the market held on to significant expectations for stimulus, basically anchoring around 2% in cuts over this year and next. It once again moved lower as this outlook got more dovish. And now as it's anchoring again, stocks managed this shallow bounce. The story to take away from here seems to be that bad news is bad in this environment, which is to say stock markets now see the Fed as probably behind the curve, and stock markets envision that anything that then looks like a dovish adjustment in expectations probably ends up being risk negative, because rather than speaking to some sort of abundant policy support at a time when the economy is doing well, they are instead concerned that the economy may be on some sort of a glide path into recession that the Fed is increasingly too late to address in a timely fashion. So when things get more dovish, it's because there's a growth concern rather than a source of optimism, as far as stock market's reaction is reflecting. And indeed, the Fed has a big adjustment that it needs to make here. If we look at what is currently being baked in for expectations, at the peak for when the markets were most concerned recently about growth during that scare in early August, we were looking for 104 basis points in cuts for this year. It's 95 now. So very little changed, looking for 4 cuts this year. Across 3 meetings, that seems to line up with a 50 basis point cut this go round and a 25 basis point cut each in November and December. That, of course, contrasts wildly with what the Fed forecast in June, where it only saw 1 cut. In order for the Fed to line up with the markets here, then, to meet them where they are, at least 3 cuts need to go into their updated summary of economic projections this week. If they cut by 50 basis points, that would leave enough optionality on the table, perhaps, for the markets to be somewhat satisfied. And I say somewhat because, of course, it would still be relatively light, but at least with enough dovish commentary, in addition to what the Fed would do there, it could be made to reason that the Fed doesn't want to jump out the window and scare the markets by being overly dovish, but the essence of what the markets are looking for could be there. Nevertheless, that would be a significant dovish adjustment. So too for next year. At peak panic, that was 100 basis points or so. Now, there's been a whole extra rate cut added, and the markets envision 5 cuts next year, not 4. That's how we've gotten to 2.28 on the cumulative cycle. In other words, we're looking for 9 cuts here between now and the end of next year. That's more than we did at the beginning of the year here, where it seemed so very unlikely that the Fed would go this hard. The markets see a harder path now. In June, the expectation for next year was 100 basis points. So at least 1 more cut to add into the forecast there. Now, that, of course, is a very high bar for the Fed to clear. They have to do all kinds of dovish readjustment. And, of course, the question for markets then becomes, will anything look like enough even if such a big adjustment is made? Put in other terms, which part of this adjustment, which is already very ambitious relative to where the Fed was back in June, which part of it isn't priced in already? And if the Fed were to, say, issue a 25 basis point cut with overtly dovish guidance, or a 50 basis point cut with dovish guidance, the market is already so set for an ultra dovish sort of path forward that the Fed would really need to start going into the realm of the improbable to get any more dovish, and may already be getting pulled into that direction by how far the markets have adjusted. And what that does is it sets up a buy the rumor, sell the fact sort of a dynamic, whereby even if the markets get everything that they've set up for, and the Fed essentially endorses them and says, yes, okay, 3 erring on 4 cuts this year, 4 erring on 5 cuts next year, the markets won't have anything else to speculate on because that much is already in the forecast. And if the markets have in any way been animated in their thinking, despite this kind of back and forth, sometimes stocks move in line with policy bets, sometimes they move inversely. We've had some periods of both here. If the overall trajectory here is stocks are near record highs and the outlook on policy just keeps getting more dovish relative to where the Fed first announced the end of its rate cut cycle, or a rate hike cycle rather, in late October, early November, if the overall direction of travel has been from S&P around 4,200 up to around 5,600, whereas the outlook on rates has been from 78 in cuts to 228 in cuts, there may be just a deflation of speculative interest here and an unwinding of speculative long positioning contingent on this still being a speculative narrative. Once the speculation drains, a round of just unwinding of exposure linked to that speculation may follow. And that could be bad news for stocks here, at least in the near term. The corollary, of course, would be a stronger US dollar. It's unclear that the long end would necessarily weaken because, of course, there's still a great deal of easing that's being expected for next year and thereafter. And the front end might get a little bit more jumpy just because immediate speculation will have cooled down. It'll be interesting to see what happens with precious metals against this context. They've shown a lot of strength through the dovish repricing over the past week. We'll see if that can be sustained here, especially if the dollar gains. After the Fed, though, central bank bonanza continues because the next thing that we're going to get immediately after is a monetary policy announcement from the Bank of England. Here, we're expected to hold unchanged this go-around. We can see benchmark SONIA futures here not looking for a change in September, but we can see that one is already baked in for November, and we're just 5 basis points shy of a second one for December, so that the path through year end looks like 45 basis points in easing. So that's leaning very much in the direction that there is a pause now and then a cut in November and a cut in December. Now, ahead of this meeting, we're going to get UK CPI inflation data, and here things get a little bit muddy because we're looking for the first increase in core inflation up to 3.5% here is the uptick that the markets have penciled in since May of 2023. So first rise in core inflation in over a year. And the first one along this way lower since the start of 2023 here that we are going to get on the way down the disinflationary path. So if nothing else, there is an opportunity here for the Bank of England to reference back to the inflation numbers and go, right, okay, so look, maybe we don't need to go quite so quickly. We just cut in June. We're pausing now, or July rather. We're going to pause now, and we are from here going to go on an every other meeting cadence. So if the first cut was between July 31st and August 1st, the last meeting for the BOE, depending on which time zone you're looking at, the night of the 31st if you're looking in the US, August 1st if you're on UK time, then we're looking at a situation where maybe it's a bit rich to expect that this second cut is all the way or almost all the way baked in. Likelihood here between 80 and 90%. And if that gets watered down a bit because inflation looks like it might be stickier and the BOE responds, then we get some way toward lightening the pressure on the British pound. It manages to perhaps gain a bit of ground. We'll see if that materializes. Of course, the still more impactful outcome would be a more dovish Bank of England in spite of data, which of course would be a bigger splash adjustment. And of course, this comes in the wake of the Fed and whatever dollar implications echo through currency markets because of that. So some interesting volatility opportunities here in the British pound based on how this goes. It's a similar story then in Japan, where we're also getting a central bank meeting. This one also expected to come up with no changes. But of course, the Bank of Japan is a bit special, where everybody else is cutting. The Bank of Japan is hiking rates. And here too, we are going to get an inflation number ahead of the announcement. Now, if we look at the expectations, they're relatively modest. So here's the 1 month overnight index swap right here, implying rates 1 month forward. That's the bottom of this range of values here. Then, of course, we get the 3 month, the 6, and in the topmost setting here is the 1 year. At the bottom is the spread, measuring this width. In other words, saying, what is the path that we're carving out here from the 1 month up through maturities and into the 1 year? And we can see here it's 0.1%. Not exactly heavy lifting. From the Bank of Japan, that amounts to a single rate hike. Generally speaking, Bank of Japan moves in 10 basis point increments rather than 25. And we have one of those increases up from 0.25% to 0.35 or 35 basis points over the course of a year. So not much change here for the Bank of Japan currently being baked out, and certainly nothing for this go-round. Here, too, though, is inflation data ahead of the announcement, as we just mentioned, and the expectation is that we're going to rise on the headline reading up to 3%. That would actually amount to a significant change, of course, here. That's the highest inflation reading since October 2023, if it materializes as expected. What's interesting, though, is that leading into this, the Purchasing Manager Index survey, the latest one from S&P Global and AU Bank, suggests that even as input costs have risen, and we can see here that the lion's share of this inflation is coming from that part of the ledger. There's a little bit of warmth in the recreation contingent here, but we can see the big bars here are fuel and food. In other words, those things that are imported inflation. And food, we can see, has been coming down. Energy was a disinflationary force that has rebased and is adding into the mix now. So all of this for an island nation like Japan is, of course, imported, and there's not a whole lot that the Bank of Japan can do about lowering that other than to maintain something of a hawkish bias and to keep a floor under the yen. What that PMI data suggests, firms have not been passing through those costs. They've been eating them. And so output charges have actually been relatively low, even as input charges, input inflation, has been increasing. It has not been passed on to consumers. So it's possible that we actually get a bit of a miss on this CPI number, which then perhaps gives us a bit of an upward nudge, but doesn't ultimately give us a stronger yen. And in fact, leaves us with maybe local markets a bit cheerier because the BOJ doesn't have a reason to go particularly hawkish in its commentary, even as it keeps rates unchanged. So there may be a bit of a yen pullback here, which in the context of a Fed that's dovish and a yield structure favoring cuts elsewhere may actually be an interesting yen buying opportunity when all is said and done. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go thereafter. We're going to pick apart each one of these macro catalysts in individual detail this week, so definitely come back and check that out. There's lots more digging for clarity that we can do here, and so we shall. I'm also on for the Price of Truth with Victor on Wednesdays, on for Futures Power Hour with Chris on Fridays, back with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and mouthing off sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money's back tomorrow.